those of us who are older, we've been through 5 cycles. And this is the first one that we didn't really cause. Like, real estate is not the issue in the world. Most of the asset classes that we invest in, whether it's multifamily, logistics, data centers, student housing, affordable housing, hotels, the underlying fundamentals have been okay. Apartments are 95% occupied in the United States. European apartments are full. There's only really one asset class that is injured at the moment. Almost permanent injury is U.S. office. Everywhere else in the world, we were talking about our projects in Berlin earlier, they're full and the rents are great. So it's a balance sheet crisis. And my comments about the Fed were, the Fed doesn't seem to really understand the makeup of the U.S. labor force today. They're very focused on increasing unemployment and relieving wage pressure. So in order to do that, there's 2 ways to do that. You can either unemploy people, the people who just got jobs, some of the hourly workers in our hotels that we used to pay $15 to, we pay $22 to an hour. Or you can increase the workforce, which involves letting our immigrants work, increasing immigration, approving visas, approving H-1B visas, and adding millions of people to the labor force that have been knocked off from the pandemic or didn't come for political reasons or pandemic, what do they call them, inoculations. The Fed, our economy was going to slow on its own. The $6 trillion of stimulus packages that were given to American consumers, they've spent it. It's mostly gone. And you can see their credit card balances going through the ceiling. So we were going to slow. On top of that, he decided to really rapidly increase interest rates. And though I agree interest rates wouldn't stay low forever, he's doing this at a pace we've never seen before. We've never seen rates go up this fast. We could absorb slower increases this quickly after telling us that rates would be lower longer in December of 21. And then, of course, he's kept actually easing through May of 22. He was buying corporate bonds. So he pulled a very fast turn. He missed inflation when it was really there because of the lags in the federal data. Our apartment rents went up 20%. We own almost 130,000 apartments in the United States. And he didn't have that in his data. And when rents started to fall, he's now showing the rent increases that were now over a year old. So I don't agree with Larry Fink, and he knows that. I actually think rates will come down in the United States because they'll have to come down. You cannot, people who talk about Paul Volcker and say that he is a disciple, Jerome Powell of Volcker, that 22% interest rates slowed inflation. Volcker didn't have a $33 trillion deficit. He had a $200 billion deficit. It didn't matter what rates were. But today, the biggest victim of the Fed increasing rates is actually the federal government that now has to pay 5% on $33 trillion of debt, not all of which rolls today. And then the second victim are our banks, the regional banks, which have a whole $1.9 trillion of real estate loans and a huge book of securities that the government told them they didn't have to mark to market, and they have massive unrealized losses in those books. So we're at a dangerous point. Credit has really dried up in the U.S. Banks don't want to lend. It's a great opportunity for private credit, and we do that too. It's a great opportunity for new capital. And Europe's a little better. I mean, Europe obviously has higher interest rates, but the asset classes are generally okay. And there are pockets that are wonderful. It's going to be a great opportunity for investors, but the Fed's going to have to relent, in my opinion, because they have no choice. None of the Western democracies can hold rates this high. They can't afford it. You wind up just printing money endlessly to pay interest expense on your deficits. So a coordination of the global central banks to lower rates, it's kind of like it's the wrong side of the what is it, the ball, the gathering moss. The unions are out using this wage tightness to get permanent wage increases, which bring inflation on. But on the other hand, we're all trying to lower inflation. And our biggest issue in the United States, and the reason the economy remains strong, is that we have all these stimulus packages that the government has put together. The CHIPS Act, the climate bill, which is really, they put out over $100 billion in that. You have the $1 trillion construction bill, infrastructure bill, the cumulative impact of which is actually holding up the U.S. economy while private enterprise is getting a little peaked. So you have a tug of war between the federal government spending and the private sector saying, ouch, these interest rates are hurting. And it's really changing things, and it will create future inflation, like we're not building enough homes. Nobody will build enough homes with interest rates this high. So it's really, the Fed is hurting themselves. And I do think we've seen the top of rates in the United States. The only wild card is oil. Obviously, that's something that nobody can really predict. But if oil were to go to $150 a barrel, it would hurt the Western economies again, and that would obviously be inflationary. So other than that, though, inflation should recede, and I think you'll see the Fed, which today you have real, we had free money. Now money is extremely tight and extremely expensive. The cost of credit has risen too far too fast. So I'll be more bullish that a year from now, I hope I don't have to not regret saying this, I think the short end of the curve, which in the United States today is 5.5, will be 4, even tighter than the curve shows. And I think you will see all the central banks will follow the U.S. The banks of the world have to follow U.S. policy because their currencies get eviscerated if they don't.
Right.
Although Japan went the other way, and they're benefiting from that.